Hi, welcome to the 73rd monthly market outlook for August 26. We have been doing this for last 6 years plus and communicating our views and thoughts to all of you the way we feel appropriate. I hope you'll appreciate our efforts and will continue to support us in this progress. We also have started new series called Market Masters, and first of the episode has been shot recently, and these are the experts from markets who will be talking to you for at least half an hour on different topics, current topics, and which will get you to you soon. First of this episode will be released before the 14th, 15th of August episode, and I'm pretty sure you'll like that as well. So let's start with the month of August.
How do you see the Middle East situation now?
Yeah, this very pertinent question because oil has a bearing on the Indian economy in a large way. So, though we are not defense expert, but we still have to discuss and look at what is happening in Middle East. So, as I see, the US is clearly want to get out of US war. They don't want anything to get involved further. I slightly observe what has happened in last 1 month. Israel has not attacked Iran at all. If you see, and interestingly, I keep on checking prices of airlines, and if you see, Qatar Air and Emirates are operating at full scale. The prices of tickets are still at its max pre-war level. Uh, Interestingly, Iran Air is flying to even Abu Dhabi and Dubai. So all that indicates. Then there is a statement recently. Whatever has drone attack has happened from some areas of Iran into onto this Qatar and other places, but the government of Iran has denied that they had done anything. So maybe from any insurgents attack and not the really full-fledged war. Saudi on the other side, Saudi Arabia has agreed to pump more oil. And what you see always, whenever this kind of news flow comes in and out, the oil is impacted immediately. Start of this, when the peace talks happened, oil dropped close to $70. Recent incidences has taken it to 90 and back to 80, 85. See, now it's very clear oil will not fall below 65 and it will not go beyond 85. So that is what is meant and read from whatever has last happened in last 1 month.
How do you evaluate India's current macroeconomic landscape?
So we need to, like last time as we spoke, we have to connect the dots. So all these macros in terms of economy is what we're going to check to arrive at certain conclusion. So last month, what we have seen, like let's start with the GST collection. So it has shown 15-16% growth on year basis. The absolute number was 1,95,96,000 lakh crores, which is very much in line with. So that shows there is no drop in consumption. Oil prices have not impacted the overall, because inflation on the other side has already gone up. WPI is 9.8, CPI is 4.3. Those numbers we have not seen for many months or many years for that matter. Slightly out of RBI's control, but still we feel the collection in terms of GST is robust. The imported goods and also the local consumption is in very much in place. Look at the tax collection. Normal the income tax collection also shown 16.5% growth, both in terms of corporate went up by 22%, and the individual tax also has grew about 11.2%. That also indicates the tax. There is no drop in corporate earnings or neither by earnings of the individuals in the countries. Though market has been very flat, hardly any contribution coming from capital gain side. Look at bank rate. There also is a very healthy situation. For the first time, borrowings has exceeded the deposit growth in terms of growth. So credit growth touched 18.5%, and where deposit growth is dropped to about 13 odd percent. That also indicates key like the borrowing from agricultural sector is about 15, the manufacturing about 17, housing about 11, and good 24-25% growth is seen from MSMEs. So I think the business confidence is slowly growing, capex is happening, and that is how we see demand for credit is going up. The only challenge is liquidity in the banking system today is a bit low, and that might impact the cost of borrowing because prices of borrowing cost may go up. And we also see the situation where inflation is up and RBI is in a dichotomy as to whether to raise rates or not raise rates. So that's one aspect to be seen. Second is the IIP growth, which came as a surprise. The recent numbers were very, very encouraging. GDP growth is about, last year we ended about 7.4. This year the start is 7.8 for the first quarter. Looks like if things, monsoon is normal, we may not, we may be closer to 7 than 6.5 if things fall in line as we expect and oil remains where it is or where it remains under control. Monsoon is very important for us. I think we had a fear of El Nino effect, but June was bad. But July has recovered the full deficit what we have seen till date. The disbursement is also quite even, barring few patches. That always happens. So right now, situation reservoir levels are all full. So that gives me a lot of comfort as at least there will not be large economic impact. The role of agriculture always been dropping every year by year. So the role has not been very significant in terms of impacting the GDP growth of the country. So that's one positive number. I look at the quarter one number, which was expected to be a bit moderate or bit subdued, but that too has been very encouraging. We have reported the growth in the all these 60, 70 companies who has gone and reported their numbers till now. The growth has been upwards of 15 to 20%, and top line also has grown. So that also is very, very encouraging. We look at this GD, the BOP situation and currency. Currency has been stable, but BOP was bad last month. There has been a recovery. There has been a recovery in terms of post the announcement of FCNRB deposits, and with the expectation of 30-40 billion dollar coming there, which is very, very helpful to bring the currency stability. The reserves also in terms of forex reserves, we had though blown 61 billion dollars in terms of defending the currency, but we had enough reserves of about 670 billion dollars to support the currency per se. So in general, if you connect all these dots, we don't see anything very negative on the macros when it comes to country, when it comes to India. So macros are improving and stable, we can say.
What is your current outlook on Indian equities?
See, last 2 years has been very subdued in terms of market. The market is trying to recover from the FI selling. You know, all this has started because of the whole AI story, which sucked a lot of money across the globe to other markets from India. India had nothing to offer in terms of AI. So our emerging market share of India has fallen from 21% to 11-12%, whereas share of other countries like South Korea and Taiwan and all gone up from by that quantum. Now this slowly story of AI is getting over, or maybe there has been some challenges to that story, and slowly these markets are getting sold and or become very volatile. That might again focus back a lot of investor on the IT companies which are very stable in terms of their revenues, their businesses and their strength in India. So, I am not saying FI will come back in a hurry, but if you see today's last 1 month, the numbers of their selling has come down drastically. It was some 50,000 crores, then 7,000 crores. If you see last 3-4 months, it has been coming down substantially. And last month, this month, we might end up slightly positive if there is a surprise in today's trading activity. So, they are definitely slowing down in terms of the selling. Overall, their share in the Indian market also has gone up to 15% of total market cap. So, they are not become very significant in a way, and the likelihood of their selling in long term also has gone down considerably. Not that all the FIs are selling. So, there are some index fund or a passive fund which has to follow the overall market capitalization. They have to sell when the share of India goes down in terms of global indices. Those long only or active fund managers are still bullish on India. You see SBI public issue of mutual fund, they contributed a lot. They have been doing a lot of large trades and primary market deals and supporting India. That so fear of FI exiting or FI selling is also vanishing slowly. Let's focus what happened last month. The, the again the story is same, like mid cap small cap has went up, large cap lot of more value stocks are still there at a very attractive valuation. Large cap usually is bought by FIs. They are not present and they are not buying. So, you will find them most of these large cap stocks and value stocks trailing at a very attractive valuation, and this situation might continue for some more time till we see FI coming back, or some fund managers will be compelled to buy when flows to large cap funds will increase. Secondly, when we see the valuation, again with the last rally which has happened from say 22, 23 500 to 24 200 300 where we are today, has driven most of the mid cap valuation and to an upward zone. Small cap, yes, very few people participate. There could be some space margin in small cap stocks to go up. But according to us, mid cap valuation is slowly getting expensive in this market rally. Market has been spending a lot of time between 22,500 to 24,500. Technically speaking, the 200 DMI is around 24,700 and 100 DMI is about 23,800. So, it is just keeping that in that range with the traders capping the upside and the supporters supporting at lower levels. This has to break the range because market has never been in this range or a shallow range for a very long time. So, we have spent more than it's a record time we had spent when the market has not taken out the previous high. Uh, some good news in terms of monsoon, interest rate, oil, geopolitical situation, the trade war getting over, the export starting, supply logistic in place, and India focusing back on manufacturing and addressing the BOP situation in terms of and currency being stable will address a lot of this concern in the stock market. If you see the trend, the market has been slowly moving up and giving a lot of rewards to the growth story or the quality, we can say in correct terms. So, these quality stocks will still move up. Their order book, their bank, their position, the balance sheets are very strong, and they are likely to grow with the smartness and the sector which they are present in. Just to give example, the power sector, the power distribution, we are at the peak of the power demand, which only will keep up going ahead. So, these sectors, secondly, we seen Indian IT is again getting confidence. It was hammered down like anything. The stocks were down 40-50%. And with this slowdown, slight slowdown in AI trades, suddenly there could be a interest revival in terms of Indian IT sector that we might see. PSU Bank has done phenomenally well. The balance sheets are very strong. The NPAs are at all-time low, but the stocks are still not gone to the previous high. We might see some good rally over there. So all this thing bode well for any investor who is long-term in nature. So Indian stock market, according to me, will slowly move up. I don't know whether it will break that range of 24,500, 24,700 in this month or August, But I feel slowly beyond September and October, as we see quarter two results coming in, and the Gulf War and Middle East War will end and oil will come down. I think that's the time when you'll see the market will start its new move. We are very positive in terms of Indian economy. Long term fundamentals, as you see, they are very intact. The valuation is not so expensive, but if there is a lot of space to invest in large cap and quality stocks. So if somebody focuses on that there, I think we are very attractive in terms of the global markets.
What are the risks and challenges going ahead for India's story?
See, India has been growing at suboptimal rates. It is not only in 20 when we reached the peak of 26,500 in September of 24, we're trading at 24 times almost. And from there, the growth never supported. The growth collapsed. So, growth actually, if you see India GDP growth average for 10 years is around 6%. And whereas the earnings growth is in 11 to 12%. Similar case, if you see Nasdaq, the US GDP growth is around 3.5, 2.5, 3%, and the Nasdaq growth is about 21, 22%. If you go to S&P 500, it is grown at about 9.5%. So if you see growth to GDP, there has been a stark underperformance for India for last couple of years, and that has really led put off many investors from investing in India. The reason could be AI spend, the government capex. India is a predominantly consumption and a service export. In terms of export, we are a service economy, and when it is service economy or when it is services export, the margins are always lower than the manufacturing exports. Whereas China, US and other countries predominantly manufacturing exports. So, the ability of generating higher profits when you are exporting is also limited with the services part of the economy. Whereas technology, innovation will lead to higher margins and higher profitability. And that is how you seen there are few companies in Nasdaq today, which or even in Korea, which are like Samsung recently reported 6 lakh crore profit, which is equivalent to the more than equivalent to the more than the market cap of Indian economy. So all that we need in India for us to grow faster compared to the other competitors. If you see the share of India in global market cap is still around 3 to 4%. US is always dominated. US share, in spite of all this problem happening, is the highest today in the history. So, what that indicates is our focus has to shift from the services to manufacturing, consumption to manufacturing, more exports, currency has to be stable, government finances has to be right, inflation has to be controlled. All that will eventually, and then overall interest rate cycle has to be benign for industry to grow faster than what they are doing today. So, these are the basic challenges which I see. Secondly, our reliance on oil is also critical. We immediately get collapsed when oil moves beyond $80. 120 is not even imagined, but at even $80, $90 a barrel, we start struggling. So slowly we are making shift from oil to EV and electric and all that. But in terms of electricity generation also at 275 gigawatt demand, will be again struggling, and higher capacity has to be created every year to meet this growing demand for the within the country. So, India in terms of oil, the exports, the currency, the balance of payment, there are many things which we can discuss today, and the capex, which is very, very critical, has to take place. The government, as we discussed in the last episode, ki government is doing the heavy lifting when it comes to capex. So, private capex is completely missing. So, now we see some kind of a revival because bank credit has grown in last 1 or 2 months. So, we see some kind of a action in primary market also. Government, a lot of companies are raising money. All that should help in the capital generation in the country, which eventually help the employment if there is some challenge for real estate or IT story of India. So these are the challenges we see today where we need to focus on.
What are your views on commodities?
See, commodities what we mean like silver and gold, which was part of our portfolio for a long time. Gold, of course, has rallied a lot, and recently there has been a decent correction. Uh, it has lost its relevance or relation to dollar, or it is not even a risk of like a hedge against risk, because geopolitical situation is bad and still we are seeing gold coming off. I think all that has happened. Maybe the one-off rally which you have seen in last year, we don't expect gold to go back to those levels or may it give that kind of a return going ahead. Uh, some of the events like investment in AI and all has really overcast the gold as a in terms of its prices and interest. So gold view is very moderate. We may generate ordinary returns like 10, 15% going ahead. But when it comes to silver, the demand for silver is still higher than the supplies. The industrial use, the uses in cheap AI, electronics, power, everything is going up. So you might see some kind of a bump up in silver prices going ahead. And but as an asset allocation, and when you talk about the multi-asset funds and all, the role of silver and gold they played last 2 years. We don't see that is happening again. So somebody is investing in multi-asset fund, looking at past returns, has to be sacrosanct of this expectation from silver and gold going ahead. So silver, gold, we can have a very minimum possible exposure in the portfolio if it warrants.
How do we suggest people to look at fixed income as an asset class?
See, we January we started with a very positive note where inflation was very benign. And then it was followed by the Middle East crisis. The oil went up, inflation went up. Inflation went up beyond anybody's even imagination. All has led all central banks to leave their view of softer interest rate and again think about interest rate hike. It's a completely, we call it a viper from one view to the one side to the other side. They have to travel all the way. If you've seen the recent commentary of Fed, the governor has to defend why he is not raising rates. He of course had three strong reasons for not raising rates, and of course had to say he is not following Trump order in taking this kind of a view. Similar is the case in India. We also are facing higher inflation. But if you understand all this inflation like WPI and CPI distribution, most of it is driven by the oil. So oil is driving the most of the inflation, and which we call it a supply side issue than a demand side issue. With demand side issue, we have fiscal tools, but for supply side, I think it is sometimes left alone because there is a chance that the escalation in Middle East can happen, the stalemate or this can stop and oil can come back to maybe closer to 65, 70 type of levels, and that will help inflation to eventually come down. The demand in all these economies also, if you have seen, is not grown. US is showing some kind of a slowdown, China is slowing down. All this means the overall demand scenario also will not warrant any kind of a sharp rise in inflation going ahead, which will warrant RBI to raise rates or central bank to raise rates. Or what it means like for 10-year GSEC in India, we were at trailing around 6.5, we went to 685 and post the oil going to 120, it went to $100, the 10-year GSEC went to 715. But the post peace talks, it has now come down to 685, and we feel eventually as and when the situation improves, the 10-year will start making its move to 675 or 650. All goes with what RBI stance is. If the commentary is so like towards not raising rates and maybe was on a softer side, then I think yields will come off. But as of now, it's a it's a it's a it can go both ways. So one should stay put or not commit too much of money in the long term as of long end of the curve as of now, and watch inflation carefully and watch RBI steps carefully.
What is your guidance to investors at this stage?
See, India story cannot be forgotten. It's a very, we are the largest growing economy in the world. What had happened, most of these events happened outside of India, impacted Indian market, like Gulf War, this Middle East war, Ukraine war, or even the tariff issues. All that has impacted Indian economy to a larger extent. The AI trade was the largest one because we never had something in AI. So a lot of money went out of our country and never came back. So there was withdrawal, forget about getting new money, there was withdrawal from the Indian market, and that impacted the performance for last couple of years. But nothing can be is permanent, is what we see. Market moves up and then the reasons are discussed. So even if we are not able to break out of that range of 23 2500 or 24 500 or 24 600, there will be some event which will take market up from the current level and the whole rally will start all over again. Why I am saying so? The fear of monsoon being deficient is little bit subsided. The war, there has been a peace talk. On oil prices, there has been a sharp cuts and there is intention of it going down more than it's going up because the OPEC is producing more oil. Saudi Arabia has joined the bandwagon. So every country which has been affected by war will try to compensate by pumping more oil and selling more oil. So we don't see any problem. So and secondly, there has been a shift from oil demand to electricity, which also bring down reliance on oil going ahead, which is all these countries are well aware of. They have few years in hand to make money, and they will see that they are not bogged down by any limitation. They pump more and sell more. So that's again one more positive thing for the market. If you see the quarter one result, which were expected to be affected because of oil price and geopolitical situation, supply logistic issue, but the result, the initial trend you can say is absolutely positive and normal. There is no sign of any stress coming from this kind of a because we could have seen top line affected from many of these companies. Yes, there is a margin issue. Margin issue is mostly coming from IT companies, and secondly for some companies because interest rates are still slightly higher elevated levels and they are not come down, which is I feel is normal. Uh, Overall macros also we have checked, they are quite intact. There is no indication of any slowdown. Real estate sector is also in the peak of its health. The auto has shown phenomenal growth, the even two-wheelers and the four-wheelers. Uh, the IT sector, which was laggard for last few quarters, has also shown sign of revival. The commentary from which has came from NASCOM and some of these industry veterans about the IT sector that margins are a bit affected, but there is no concern for the business. That gives more confidence for a steady businesses which India has generated in terms of IT services over a period of time. Yes, we can differ about valuation because this thing will grow at 15, 16 times percent and they were trading at 40, 50 times. That was complete mismatch. So post this correction, we don't see any further downside to IT and it could be only things can go up. Banking has showed phenomenal performance, except for HDFC and ICICI or Axis Bank. But rest of the private banks and PSU banks has reported stellar results. reduction in NPS, higher margins in spite of rates being up, all that indicates there could be a re-rating of PSU banks going ahead. Automobiles, as I discussed, the auto ancillary, the financialization sector also is. So I'm just tracking the sectors which is reporting higher growth. So it's a very broad market which is showing high growth in the country. Now question comes, how much multiples one can give to each of these sector and what will the ultimate impact on the portfolio. In simple manner, we feel any PMS, AIF or mutual fund which has shown last 3 years growth more than the market. I think the fund manager is tracking the trend and is in sync with the market. Just go back and see your returns on your fund which you are holding from say 1st of April till now, and if you are if you are seeing that it is able to beat the benchmark, I think we should stay with that fund for sure. There has been disruption in terms of the mix the fund carries because they are large cap, mid cap and small cap in the portfolio, and one sector like large cap has dragged, and that is how we have seen most of the funds are not able to deliver in at par with maybe a AIF or a PMS schemes which only drives on mid and small cap stocks. But keep in mind we need a balance. In long run, always quality matters. So whatever portfolio you are holding today, see we have enough quality in that portfolio. It is able to beat the underlying benchmark. Consistency is very important. So look at fund manager which has been consistently delivering returns. I don't want to name the AMCs at this stage, but the information is available in the public domain. And staying invested is more important because timing the market nobody has succeeded. Even if you have fresh money, we suggest one can look at distributing over next 1 or 2 months, not more, because keep in mind we are spend enough time in terms of correction. Time correction and value correction is almost over according to me. Market is ready to go up. The only thing is we don't know which day and which month. But definitely from here, don't keep too much of cash in the portfolio. Stay invested, and reasons will be known later, and market will be move first.